No inflation. Oh, just 3%. Oh, it's just transitory. Oh, it's peak. Oh, it's just Putin. So they've been consistently wrong. Now, the only plausible excuse for being consistently wrong is what you're saying. They're trying to calm the markets. But if that's the case, I think they've sort of overstayed that, because it's destroying their credibility. Normally, gold stocks have high valuations, as you know. Typically, gold stocks for 40 years have had high valuations. And people ask me why, and I think it's frankly because, you've got to be an optimist to invest in gold stocks. And so the valuations tend to be high. People are always looking ahead. But just to come back to that, you look at the XAU, net cash positive. Net cash positive. That's astonishing for a capital-intensive industry. They should have debt. It wouldn't be surprising if they had debt, but it's net cash positive. You look at the dividend yield. The dividend yield on stocks today is higher than on the S&P. Barrick is yielding 4.8%. Barrick is the second largest gold mining company in the world. To me, it's astonishing. And then you look at individual stocks. I just pulled up Barrick. Let me look. Barrick's price to free cash flow is the lowest it's been for 10 years. Now, that just doesn't make sense when the price of gold is where it is. I understand that the input costs are going up, but the margins are still very, very strong for these companies. Very strong. If your all-in sustaining costs are $1,100 or $1,200 and the price of gold is $1,750, you've got a 40% profit margin. There's nothing wrong with that. And so to me, for a company like Barrick to be trading at its lowest, it's basically its lowest price to free cash flow in 20 years. It just doesn't make sense. So first of all, I look at valuations, and the valuations on the gold stocks are very, very low. The other thing that's a good indicator, frankly, to me, it's an indicator of capitulation. When a company has bad news and the stock just collapses, you saw that with Newmont when their costs came in higher than expected. And frankly, that shouldn't have been such a big surprise because Barrick, which runs Nevada Gold Mines, which is jointly owned with Newmont, had already pre-announced its costs on Nevada goldfields. And yet Newmont collapsed. When Pan American said they were closing the underground of Dolores, which is one of their mines, the stock collapsed down, 4 points on a $22 stock. Newmont was down 13% at one point during the first day after they announced their earnings. So when you see stocks collapse on bad news, particularly if the bad news isn't all that bad, then that's a sign of capitulation, I think.
Yes. Good point.
And people are just trying to get out of bad stocks.
Walk us through this. You and I have had conversations over the years, and your knowledge of the royalty companies versus the miners. Walk us through that. It's so important, number one. That's my first question. And my second question is around, you made a great point like 6 months ago, we were talking about silver miners and these ETFs. There's really very few silver miners left that are just pure silver. And like in the 70s and 80s, there were real silver miners that just mined silver. So get into the royalty companies and then that dynamic.
Okay, well, that's two different subjects. Yeah, but royalty companies, I think everybody understands the royalty companies because, even if you're not familiar with gold and silver, the royalty companies in the oil and gas space. They've been around for a long time. They've only been around since the 1980s, frankly, in the gold space when Franco-Nevada started. But the whole concept is that a royalty company will make an upfront payment in return for a percentage up the top, typically up the top, for as long as the mine is in existence. And the beauty of that, of course, is it means that the royalty company isn't responsible for things that go wrong. Now, if the mine closes, obviously they don't get their royalty, but they're not responsible for wage increases or extra taxes or environmental issues, or if there's a blockade on the mine, or if the pit wall falls or anything like that. They don't have to fix them. And one thing about anyone that's in the mining business very, very soon realize, and around the mining business, very, very soon realizes, is that things go wrong. That's a standard. Things go wrong. Robert Friedland, of Ivanhoe, likes to say Murphy works overtime in the mining business. But the royalty company is a good one, right? But the royalty companies, or the streaming companies for that matter, are not responsible for those cost overruns or any kind of issue. And so the mining
companies now look most attractive.
Yeah, so the royalty companies tend to be lower risk, and they've demonstrated that over the last 30, 40 years. The problem is when you look at royalty companies, if you're a Graham and Dodd investor, you'd probably run a mile because the valuations tend to be high. We could talk about that, but I think the valuations are justified, to be honest. So, Franco-Nevada, which is the largest, and the most consistent performer over the years, that to me is a core. For someone who just wants one gold stock to buy and forget about, it will be that one. Wheaton Precious Metals, which is a streaming company, not a royalty company, that is particularly undervalued right now, but for a reason. And that is, their largest asset, Slobodo, which is run by Vale, has had some problems in the last year. And so there's a reason it's low, but it's got a super balance sheet, and I think that'll come through. And the other two large ones, Royal Gold and Cisco, I think both have perhaps arguably more upside. So I think they're all good buys here. We're buying them all. And one of the things we should remember, typically, if you ask anyone in the mining business or gold mining, an investor, typically they'll say, oh, well, the gold royalty companies are great in a bear market, but when you get a bull market, oh my gosh, you want to be in the mining companies. And, because they've got the leverage. I'll say two things. One is, the royalty companies do have leverage. They have leverage because typically in a good, strong market, mining companies will increase production, they'll expand, and the royalty company will typically buy royalty on all of the ground, not just on the mine itself, but they'll buy a royalty on the ground surrounding it. So if a mining company starts doing brownfield exploration around the mine site and finds more ore and increases production at their mine, that's all to the benefit of the royalty company, which, remember, has not had to pay another dime for that leverage. The second thing, though, to remember is if we're entering into a period of inflation, the royalty companies are far less affected by cost increases than are the mining companies. You look at companies like Franco and Royal and Wheaton, their margins are 90%. So even if their costs double, it has a lot less impact on the overall profitability of the company than it would for a mining company. So they are the ideal vehicles. And we saw this, Larry. We saw this in the latest quarterly reports. Whereas most mining companies were having some kind of cost issues. Even Barrick was up. Agnico's the only exception to that. And there's a reason for that. But most of the mining companies were having cost issues. The royalty companies pretty much all came sailing through.
And getting back to that silver question. So, I look at silver here and I'm thinking solar panels in China now have, the new solar panels in China have two sides. And the new technology in solar, from what I understand from reading, all the different white papers, it looks like, in the innovation of solar technology and globally, you're going to use more and more silver there.
Correct.
And I think 15-20% of current silver demand annually comes from solar, and that's been creeping up. And then electric vehicles. But I'm looking at solar. I'm looking at silver miners here, and what is there a pure play on silver? Is there a company that's a pure?
Well, yeah. You've hit the nail on the head. If you go back to the 70s, something like 70% of silver was from pure primary silver mines in the US, as well as in Mexico, in Russia, and throughout Latin America, Peru, and so on. If you look at the silver production today, something like 75% is byproduct silver. So it's completely flipped. Now, some of that byproduct is from gold. So you have a gold mining company, a gold mine has some silver offtake, fine, doesn't make much difference to the equation. But a lot of silver is byproduct of a copper mine or a lead mine or a zinc mine. And, and that's why silver today does not respond. Silver production does not respond very well to changes in demand in the way that gold, the vast majority of gold, the majority of gold is from primary mines. And so silver production, gold production will change in response to changes in demand, up or down. But if the demand for silver goes up, the guy that's got a lead mine in Bolivia doesn't decide to close it, or a lead mine in Malaysia or in Bolivia doesn't close the mine because his byproduct silver demand went down. For him, silver is simply a byproduct, and you sell it at whatever price you get for it. And so silver supply does not respond to changes in demand for silver, either on the positive or the negative.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.